Scale matters when you are a royalty and streaming company, and Triple Flag Precious Metals made news this spring when it raised $250 million. I'm with Shaun Usmar. He is founder and CEO. Shaun, welcome to Kitco.
Yeah, Michael, thank you. Thanks for the opportunity.
Shaun, there's a lot to discuss, but we're going to begin with basics. Streaming and royalty. What's the difference between the two? When would a company sign up for a streaming deal, and when would they sign up for a royalty deal?
Yeah, it's look, obviously we've got both in the portfolio. I think a simple way to think about it is if companies are looking to raise meaningful amounts of money, typically that's a streaming deal. So, you look at the largest deal we've done in our 5 years. It was last year with North Parks. That's $550 million. And it's a gold and silver stream. It's a more efficient way of being able to arrange financing at a good cost of funding than a royalty. Usually we'll see royalties with earlier stage opportunities or occasionally, royalties that were in fact inked at an earlier stage, which have actually grown in value that can be really valuable. So we've got a royalty on Fosterville, for example, and that's obviously a pretty prolific asset, but that was generated at a time when, it was obviously less valuable than now.
Now, there's other streaming and royalty companies out there. What was a pitch you made to investors when you raised the $250 million?
Yeah, so I think there's two categories of investors and two time horizons. We started this business in 2016 from scratch. And our idea at that time was that, the traditional capital markets were, let's just say the mining sector is probably underserved. I think that's probably true today still, particularly when you think about growth. And as people with deep mining experience, it felt that there was an opportunity really at the upper end of the streaming and royalty space, larger checks, deep know-how onto structured transactions, to take that form of financing and essentially grow the pie. And so you'll see we've looked at over 500 transactions in this period for 16 deals. And we've got 75 assets that have come out of that. But there's been a lot of work to try and develop that over time, and we've seen a fairly consistent deal flow. Now, to make that work, you need someone who's got the sophistication to understand it and a long time horizon. And Elliot's been that partner for us. They're a fund with over 40 billion under management. They've been in business for over 40 years. And really that longer term horizon, that deep focus on value and the ability to think through risk, I think was ideal for us as partners. We always envisioned, because you started the segment by saying scale matters, and it does. The higher quality opportunities, by definition, very often the barrier is not just know-how, it's the check size. And so with Elliott, we could play at the largest check size out the gate. But we always felt that, and we, funny enough, had a 5-year time horizon in our original business plan, that we thought if we'd executed well, that 5-year time horizon would allow us to achieve a scale that meant that we could naturally broaden the ownership base. And that's really what the IPO represented for us. So, that's really what we did a few weeks back now, $250 million with some really good new owners as part of our business.
Now, you talked about the founding back in the mid to last decade when it was obviously easier to get deals. It would be juniors and developers. They have more options right now. Is that kind of an impediment to getting deals?
Yeah, it's interesting. I think there's a recency heuristic around a lot of people, how they view things. We obviously invest in through the cycle. And if you go back to, it was April 2016 when we invested and started this business. Bear in mind, we weren't spun out. We didn't have existing assets. We were an unknown quantity. I think we were underestimated, and that's always pretty handy. But the narrative that was out on Bay Street and elsewhere was, the large deleveraging deals that you saw with the diversifieds and the gold majors. And I was CFO of Barrick when we did the Pueblo Viejo stream. So, we've had deep insight from the miner's perspective on how to weigh these alternatives up and how to structure them. Those deals are gone. So there's not a lot to do in this space. Whereas, we really felt that there was an opportunity to not just compete directly on a limited pool in bank-led processes, but to expand that opportunity set. And I'd say now, I've shared the numbers, but, we've probably only had 2 weeks early on where we haven't been in deal execution mode. The nature of the deals ebb and flow, but that value arbitrage between what these ounces are worth, for example, in the portfolios of diversifieds versus in the hands of a streamer. You look at Anglo, you look at Rio, just as an example, they're trading at sub 4 times EV/EBITDA multiples. That's more like on average 16 times, in 2021 terms with the peer set currently. So, if you can structure good deals, we've had, for every competitive deal we've done 3 bilateral working opposite a miner to come up with ideas. So we put a lot of ideas in front of companies, really to try and find solutions that work for both sides, because there is a zone here where you can be enabling to these businesses and create good value for your shareholders.
What do you monitor if you're looking out and then you're engaging with a broader investor community? How do you do it? It's always a question I ask, as CEOs, when they have to talk to the investor base.
So you mean more from just the sort of themes, or
just talking about business news, or just kind of monitoring you're talking to investors, and there's so many ways that investors can consume information about Triple Flag or anything in the mining industry. What's important for you to engage with?
Yeah, it's really interesting. Having come off a roadshow recently with a pretty broad cross-section of investors, obviously you've got a number which are specialists. They've got a lot of deep knowledge of, frankly, not just the mining space, but the streaming and royalty space. And very often they've done a lot of pre-work, and they'll get into the weeds on individual assets and try and understand the differentiation. So we then focus very much on the distinctiveness of what we built. And so things like position on the cost curve, essentially more than 80% are in the first half of the cost curve. That's not accidental. Things like jurisdictions. So more than 80% of the portfolio are in investment grade jurisdictions. Again, mostly we're in Australia and the Americas, not accidental. More than 90% of the portfolio is precious. And so they ask questions around, well, what happens about, diversifying into other metals, and how do you think about that? We'll do a little, but we stay very targeted on our sort of core precious focus, because that's the mandate. There's always questions about deal flow and trying to understand our ability to compete. And our track record now, I think, speaks for itself. We've had about a 14% market share over time, but we focused very much on being true to the model. We've got massive land packages associated, which we've been disciplined about. So our reserve and resource position, just to put that in context, is less than 1% of the overall roughly 9,000 square kilometers of prospective land in the portfolio. And that is very important for this model, because even though we've delivered the highest number of ounce growth from our inception through to, say, 2020, last year alone we grew 49%. This year we'll do another 35% in ounce growth. What makes this model so compelling is that over time and patience, when you invest well, it gets rewarded through mine life extension and the ability to participate in new growth and new opportunities. So there's a lot of those kinds of conversations. I think our portfolio as well, we have on a weighted average basis more than 25 years of portfolio life. And there's only really Franco and Wheaton who have that characteristic. Most are sort of half that. So that means you get, multi-price cycle participation, and that's before you've even had the benefit of mine life extension, which is a really important characteristic of this model. So I'd say with the specialists, there's a lot more of those sorts of conversations. With the generalists, they very often are less interested in a specific mine. It's really more the characteristics of the exposure, the track record of growth, what to expect into the future, perhaps views on gold and silver, as a commodity, and really the robustness of the cash margins. We've got over 90% cash margins in the portfolio, and I think when you overlay that with diversification that is very rare in a mining company, you don't have strong concentrations. You tend to see that, and I think the Europeans in particular, and I've seen it in Canada, we had a number of investors with a very strong ESG focus that's core to us and how we've built our portfolio. So a number of those, and some even had separate, sessions with specialist team members to focus just on the ESG credentials of our team, our business, and the portfolio. And I think that's an increasing trend that we'll see in the years ahead.
You really lead with ESG on the site. If I'm an investor in Triple Flag, what assurances do you provide around ESG compliance?
Well, firstly, I think the first thing is look back at our track record. Our stance is simple, and that is unlike equity investors and certainly debt investors, our time horizon is infinite. It's incredibly long. So the most important decision we make up front is where we choose to commit our capital. So it means our screening up front of the operator, the operations, their track record on community engagement, tailings, their safety track record, environmental, etc., becomes paramount. And our stance has really been quite simple that, life's too short to deal with a lot of those complexities. Once you're in that quagmire, if you've got that very long time horizon, it can be really problematic. Our focus is if it looks problematic, typically it's just the third rail we don't touch. And so we've backed out of a number of situations very early on where we've just had concerns. It doesn't mean that they are overwhelming, or indeed some competitors have done deals in those areas that I'm sure are going to work out well. But it's an area we've tended to focus away, if we have concerns. We maintain, obviously, very strong relationships and monitoring after the fact. Our first ESG report, now that we're out and we've successfully IPO'd, should come out in a couple of months and will provide further evidence. And I feel we've also just got a role to play as part of the mining ecosystem in advancing this topic. So with investors and as an investor, we've done a lot of fundamental work, for example, on the carbon footprint, not just of our direct activities, which are really minimal, right? I mean, your flights and office, etc., but really going down to the asset level, looking at the carbon intensity of the attributable metal ownership we have in these assets. We worked with a partner out of the UK, which we saw as leading, so that we've got a definitionally consistent way of doing this. We've then looked at it retroactively. We modeled it into the future. We include that in future investment decisions. And then we've bought accredited offsets so that we're carbon neutral, and we'll continue to do that. And we feel it's a natural trend and direction, and we've got a role to play, I think, in helping advance that going forward.
Do you have a triple flag ESG framework that you put together, or are there kind of industry standards that are developing if you're assessing Project X or Project Y?
We do, and part of that, obviously,
when you say we do, it's a triple flag framework or an industry framework?
It's a bit of both, and what we're seeing is harmonization, right, going forward. So firstly, if you've been in this industry a long time, I know ESG is a core focus right now, but sustainable development and things like that have been core, and corporate social investment have been core for a very long time. So when I was fortunate to be one of the early executives in Xstrata through, from beginning to end, we won Dow Jones Sustainability Index as relative newcomers 5 years in a row. It was a source of pride within that organization that a relatively, new, nimble group could engender that identity and the ability to be a force of good with the local communities and invest very proactively there. So even small things like, I remember when Haiti had that terrible earthquake years ago, we had no assets in Haiti, but Mick Davis and the team at the time contributed about $1 million to the recovery efforts because we happen to be in the Dominican Republic, the same landmass, and we felt we had a role to play. And those things really are part of the identity of the individuals in the organization, and it's something we're passionate about. Our team is very passionate about, and we don't pretend that we've got all the answers, but we know we're going to continue to learn, evolve. You'll see when our ESG report comes out, I think there's work that we're doing to map the various standards, how we comply with those, and to really provide transparency on those points. So I think it'll address it very directly.
I'm talking to you in early June. This has obviously been a great, a great couple of weeks for gold. We're bumping around the 1900 level as well, too. These will be great prices. Let's talk about gold vis-a-vis cryptocurrencies. And, that is another asset class that people would be interested in if they're interested in precious metal space. So what's your thought on cryptocurrencies?
Yeah, it's interesting. I think it was Warren Buffett and Graham before would talk about in the short term, the markets are a voting machine, and in the longer term, they're a weighing machine. And it feels a little bit in the short term that when I think of crypto, it feels like a voting machine. When you've got such volatility on the back of tweets and that moving around, when you are seeing 20, 30% movements in this, trying to get a grasp of what's fundamental here is, I think, very difficult. So when you think about streaming and royalty companies, there's physical ounces, there's growth, there's a significant dividend getting paid, there's fundamentals and fundamental stores of value associated with that. You think about crypto now, and you think about something like Bitcoin and then Dogecoin, where, as I say, if Dogecoin has been was started off as a joke, after 7.5 years, I think has outperformed Bitcoin by 2,800% or something insane. What does that really mean, and the direction this is going to go in? And then you think about the proliferation of these coins, nearly 10,000 of these, no real barriers to entry as it moves forward. I really do wonder. Clearly, people are going to make money. People make money in pyramid schemes, right, early on. So where it's going to settle out and how this plays out, I think is going to be very interesting. I also think that it's perhaps not coincident at a time when people are stuck in their basements, maybe have few entertainment alternatives, and maybe need this excitement in their lives, that we've seen this phenomenon along with Reddit. I wonder. It's really been quite hard to certainly rationalize from a fundamental value perspective.
I have a non-triple flag question, but I had to drag it in since I saw it was on your resume and you had your stints at Xstrata. We always hear about nickel, and now I think you have some removed from it. If we see the demand that is anticipated, how will the industry respond?
It's interesting. I've had for the longest time a real concern that at least when I think about class 1 nickel and I think about sulfides, not only has there been a significant underinvestment in exploration, in growth for a long period of time, I actually think there's a real know-how capability. I think you can look at the mining space with a generational shift, and we haven't attracted young talent really into this space for quite some time now, understandably so, I think. I think that is a problem when you think about the ability of the sector to meet supply, which is anticipated going forward. So that's point one. We have some exposure on the Talon Nickel project. I think Shaun and Henri have done an amazing job in that joint venture with Rio. But there's not a lot of examples like that out there, and the timeframes are quite significant. So I'm quite interested to see how that runs up. I drive EVs. I think they're definitely a way of the future, and I think the likely demand scenario could surprise more on the upside than the downside, as skeptical consumers actually drive these things and realize they're almost free to maintain and very cheap to run. So I really do anticipate you're going to see more of that. I do think on the other side of that, if you look at what's happening in Indonesia and what they've done with laterites and being able to actually produce nickel for battery purposes, I think that is going to potentially cap some of what you might see on the pricing side. But it's going to be a fascinating period over the next 5 years plus to see how that unfolds, and frankly, how a lot of these car companies and that meet their raw materials needs. I just think they're going to struggle.
Shaun, thank you for speaking with Kitco about triple flag and a few thoughts on nickel and EV as well.
Thanks so much, Michael. It's great chatting to you.
He's the founder and CEO of Triple Flag. My name is Michael McRae, and you are watching Kitco Mining.